In today's investment landscape, the allure of alternative assets is undeniable. As traditional portfolios evolve, savvy investors and institutions are turning towards a diverse range of options beyond stocks and bonds. From the tangible appeal of real estate and art to the digital intrigue of cryptocurrencies and NFTs, these assets are reshaping the concept of diversification. But why this shift? It's not just about seeking higher returns in an uncertain interest rate environment. It's about strategic portfolio enhancement. Alternative assets can offer unique benefits, acting as a hedge against market volatility and inflation, thereby reducing overall portfolio risk. However, this new territory comes with its own set of challenges. The complexity and due diligence required for these investments are higher, and liquidity can be a concern. As we navigate this evolving investment terrain, it's crucial to understand that alternative assets are not just about higher risks for potential higher rewards. They represent a fundamental shift in modern portfolio theory, offering new avenues for growth and stability. Ric, can you get us started? What are the benefits and risks of alternative assets compared to traditional assets?
Well, we have to recognize that the economic environment has radically changed. The financial services industry has evolved dramatically over the last 15 to 20 years. The traditional asset classes, of course, are stocks and bonds. The problem is that if you look at the number of stocks that are publicly traded in the United States, 15 years ago, there were 7,500 of them. Today, there's less than 3,000. It's kind of funny that the Russell 5000, the Wilshire 5000 index has only 3,000 stocks in it. Companies used to go public in order to raise capital to grow. So that doesn't happen anymore. Today, young companies get private equity. They get venture capital, angel investing, and PE funds. And when they go public, they're not raising capital, they're cashing out. And that presents a problem for investors who are looking for really good investment opportunities. I mean, you could invest in Microsoft at its IPO 40 years ago. Well, by the time Facebook did its IPO, it was already worth tens of billions of dollars. So this is forcing investors to look elsewhere, to seek alternative ways to enjoy the kinds of returns that are available in the economic marketplace. And that's why we need to pay attention to this asset class and why institutional investors are doing this very extensively. Endowments, pension funds, insurance companies, sovereign wealth funds are all very heavily engaged in alternative investing because these offer the opportunities that we used to traditionally get in the public stock markets, but really aren't there anymore. We also have technological innovation through fintech, not least of which is AI and blockchain and digital assets technologies, which are creating entirely new investment categories. We have the opportunity through tokenization, which is an outgrowth of blockchain technology, where we can demonetize and therefore democratize assets of any kind. You know, most people would agree that owning the Willis Tower in Chicago, the former Sears Tower, would be a pretty cool thing to own. The problem is it's worth $1.5 billion. There aren't very many people who can write that check. But if we tokenize it, the way we tokenize companies, now we can take this $1 billion real estate and cut it down to tiny pieces of $10 each that anybody can afford to buy. So we have demonetized the asset. We have democratized the asset, and we have created inclusion. Anybody can now invest in what were highly expensive assets that are now liquid, that are now affordable, and now tradable on a daily basis. This is extraordinarily exciting. And so we're going to see the access of asset classes to every investor on the planet that previously were only available to the very wealthiest. And this is going to result in massive wealth creation on a global scale and an inclusion level that's going to help eliminate the inequities we have in wealth inequity and asset income inequity that is going to help eliminate poverty on a global basis. So it's all extraordinarily exciting. And this is why alternatives are something that you really, really need to be paying attention to.
The world is changing very quickly. And certainly we've seen the Yale universities and Harvard endowment funds really leading the way, investing in alternatives through hedge funds and more illiquid investments. I want to ask David, What advice would you give to self-directed investors? Should they consider alternative assets or should they keep things simple?
Well, it depends. So, if we actually were there with tokenization of the Sears Tower, it'd be much easier. The challenge with alternative investments, particularly the liquid ones, private equity, venture capital, things like that, is it is very much been driven by institutions, and access is key. There's these big institutions try for years to get into the best managers, and the range of returns within the alternative space is much wider than you see in the public market space. And so the way to successfully, let's say, private equity, venture capital, is you need many positions, and then some return 100, 1,000 times. And as individuals, even as there's more platforms to invest in, most individuals don't have the capital to spread out into the number of positions they need in order to benefit from some of the asset classes. Now, there's others that it's easier. Real estate's getting easier with some of the platforms. Certainly, individuals can participate in crypto, art. There are more opportunities, but there's a long way to go to where, as an individual investor, we sort of have the same competitive landscape as institutional investors.
Yeah, I think David is absolutely right about that. What I've described is a future state more than it is in the current mode. The future is going to be very exciting. We need to be paying attention to this. But the notion of tokenization remains in its infancy, but the future is very bright. In the meantime, there are asset classes in the alternative space that are worth looking at. And we would consider this thematic investing today, where you can look at green energy, you can look at robotics, AI, fintech, ag tech, ed tech. There are dozens of ETFs available on the market today that allow you to thematically focus on these very specific narrow sectors that do provide you the liquidity. If there's a downside, it's the fact that they're only limited to investing in publicly traded companies, but it's better than nothing, quite frankly. And these investments, I think, could serve as the basis for an alternative sleeve in a diversified portfolio.
Gary, you come from a world of hedge funds where it's sophisticated investors, accredited investors. How do alternative assets fit into their broader investment strategy? And then can the average person get access?
I think it's difficult for the average person to get access. And, David and Ric, their responses on this question were very opportunistic. And I completely understand and agree with the idea of trying to make these assets available to a greater number of people. And my firm is set up to do that. But I think it's difficult. There are regulations that prevent hedge funds from taking on large numbers of clients, which means they need to take on clients with large accounts. The other thing I would add to this is I think too many advisors and mutual fund managers are really closet indexers, or worse. They'll put you in so many mutual funds that you basically own like the Morgan Stanley World Index, but with tons of fees. The other thing that I would add here is that alternative assets can give you different exposures, and the managers there are trying to outperform and largely have an incentive to outperform. And I know we hear a lot about diversification, but I think that's hugely overrated. Concentration based on great research is the way you make fantastic returns. From a mathematic point of view, once you're out past 15 or 20 positions, there really aren't statistically more benefits to diversifying. So better to own 10 or 15 or 20 positions where you have a great thesis and great research and you see things differently than other people. The other thing that I would add is I think so many people have fallen into this trap of we're in a good market or a bad market. If the market's going up, they're making money, they're happy. If the market's going down, they're unhappy, we're all losing money. And alternative asset managers might not just be asset gatherers. They'll focus on making money in any market. And the past few years have shown there are good reasons and good times to change your exposure rather than being 100% long all the time. One of our mantras at Deep Knowledge Investing is that we don't believe in good markets or bad markets. It is our job to find ways to make money no matter what the market position is or whatever the market situation is. You can always reduce your exposure. You can change your exposure. You can short things. There are always ways to take advantage of whatever the current situation is. And so I think when you have that kind of outlook and you're as opportunistic as Ric and David were just talking about, I think there's a great case to be made for alternative assets.
Great insights. Let's go to segment 2.